Good afternoon. This is John Szymanski, just checking in with a live stream that we'll be recording and re-releasing later this afternoon in case you've missed us. It is Wednesday, April 22nd in the year of 2020. Currently looking at the markets right now, we are we are up um, about almost 450 points on the Dow, as well as in all other major markets, S&P, Nasdaq, Russell. Russell's only up about a percent though, so that's trading a little flat. So that's one thing I've been looking at a lot in trading inverses. A lot of people might rush to get an inverse just on the Dow or the S&P, which S&P is preferable in my book. I would steer away from a Dow inverse simply because even if it tanks, there's not as much of a percent gain that you're going to get on it. Also, be careful in trading inverse ETFs in that they're not cumulative in their effects, such as a Dow index might be, or an ETF that's a long, that's holding in a long position, also accumulating with uh, dividends over time, so that it's a reflection of a market over time. Whereas inverses are, especially triple level inverses, because you can get them at, just an inverse of the market, twice the market, or three times the market. They're also trading, depending on the ETF or the inverse, they could be trading swaps. They're trading other devices that derivatives, other instruments that make them well, so they can get leverage three times or two times. Uh, so they're not necessarily accumulative. So even if the markets are going down over a long period of time, if they're not consistently going down large gain points on the losing side, then you're not going to get a very good impact of your overall gain. So there, you wouldn't necessarily have to day trade them, but you would want to be getting in and out of the market, not on a mid to long term, but on a short to mid term, a short to mid term time duration. Now, of course, none of this information is um, specific investment advice. If you want specific investment advice, you should always consult a financial advisor. In my past profession, that's one thing I did do, and it's a little bit different when we sit down and we look at an individual's situation versus just the overall markets as a whole. We have to consider things like time horizon and risk tolerance, which you should be considering with any information that you're filtering through, even the information on podcasts such as these, where we're discussing things on the macro side. Obviously, if you're got a 20-year, 30-year time horizon, now may be the opportunity just to go ahead and buy in and start dollar cost averaging over many years and accumulating. So if you're theoretically, if you're younger and have a long time to retirement, saving in something like your 401k, now's not such a bad thing. Now's the time possibly to just put more money in overall and blue chip stocks, or stocks gaining dividends, or stocks that are going to just basically last the duration over a long period of time. However, if we're just trying to take a look at current market trends, we do want to look at there is a lot more on the downside. So and even on the long time horizon, hedging yourself, you can use these inverses as a hedge as well. Even if you're not trying to necessarily glean a profit from them, they could just be a general overall hedge. If you're heavy in any one sector, there's inverses in different sectors. There's inverses on the market as a whole, is one option. And the other option is, of course, always options. If you have concentrated positions, a little put protection is always a good idea, even if it's not necessarily going to make you money. Options can be written so that you can sell a call and buy a put, but it's getting a little more in advanced strategies. And also, even if you can do it, or you have the functionality to do it outside of your retirement account, because they're not going to let you run those strategies in a retirement account. Uh, you still may not want to bother with all the trades if you're just going to hold an inverse ETF. It may be the simple way to go. versus using that hedging strategy. Although, depending on the amount of money you have invested in a concentrated position, hedging strategies with derivatives is not out of the realm of something you may want to entertain in order to protect yourself from uh, downside markets such as we have now and such as we may be continuing to have. Now, I go a lot more in depth on my individual podcasts and especially on my various levels of my Patreon, which can be found by looking up John Stanley Media, just three words, John Stanley Media, when you go to patreon.com. I would suggest and I request that everyone that enjoys my information here and wants to dig deeper, that will definitely assuredly address everything on a much more specific basis. Again, not specific financial advice, but just more into the details, more into the metrics of how we're coming up with some of our assumptions in that channel, on that channel, rather, under the patreon.com, the John Stanley Media. I'll be putting out links on the John Stanley Media Facebook page as well. Facebook is a great launching place for a lot of the different channels that I am involved with and help participate in on the John Stanley Media Facebook page. Again, you can just look it up with John Stanley Media on Facebook. And there's definitely a lot of free information out there, a lot of good analysis, and we're trying to do this on a fairly regular basis. The general broadcast and live stream, so that we can encompass as many people as want to partake in that. And of course, we'll just rebroadcast, and then again for the Patreon members, uh, we'll have a lot more information that you can view at any time. That's part of the perks of the membership. But what I want to look at today, a little teaser here, what we'll look at today is a couple stocks that I've been looking at. We're going to look first at one that's been doing pretty well today that I've just been following a lot of the overbought, oversold charts, and uh, one that's definitely popped up today. 29% gain is Snap, SNAP. Now, if we take a look at the chart of Snap, we can also see with Snap. Well, that's FECL. Let's take a look at Snap right here. We can see, oh snap, there it is. It's a definite uptrend here, and with a spike right here. So for all the day traders out there, that would have been a great. I saw this early this morning. That'd been a great thing, to get in right about here when you're certain it's an uptrend and it's snapping, and then either put a stop loss back at 1535 and hold on to it, or just take your profit right there. But for a little bit longer term, we're looking at some of the fundamentals of that, and it's long term. I agree with this rating here that we have for mid and long term, that the technical events have put out as bearish for mid and long term. I can see that because I'm looking at the overall mid to long term markets as a whole. I'm pretty bearish on everything right now, but in the short term, it does say bullish, and I would say short to mid, so somewhere in the midterm, it may look. I think we'd have to revisit it really at the midterm. Long term, again, I think bearish because the markets as a whole are pretty bearish. But if we look at what it does telecommunications, networking, and an environment like this, it's a good thing to keep on your radar. I would get into it on a dip though. I wouldn't. I would. I. It assuredly is going to have to stop going straight up and make a dip somewhere in there. When it does dip and then go back up, then I would see it as a viable candidate to get in. It looks like a lot of people have got in here pushing this stock up just because money needs to go somewhere also. So that's another thing we want to be looking at is money needs to go somewhere. I mean, even if into to the dollar, that's going to have an effect on something, or securities, or commodities. But we're looking at commodities like oil that are virtually zero right now, especially in long-term contracts and futures. So, money's a lot harder to go there. Gold being up, gold's actually up, went up over platinum, uh, which is definitely an indicator of the possibility of recessions and depressions. So we need to take a look at that, and we need to gear ourselves in for a very bad earning season. That's probably a very bad earning season that will be coming up through the end of this year, most likely through the beginning of next year, unless we allocate and have a huge surge with government money coming in. Then it's going to be selective. We're going to have selective companies, typically your larger companies that will do well. Most likely the Dow will be affected in a positive way, but it's not going to be across the board, especially when, like I stated before, with your Russell 2000, with your S&P 500 overall, may still be a little lackluster through this next year. That corresponds to what the CEO of John, or I'm sorry, the CEO of Morgan Stanley said recently, that he sees recession through the year of 2021. That's the outlook currently. Things can always change, and we can readjust as we go further. But right now, I don't. I see mid to long term as being lackluster. Very, very, very long term as being good. So if you have the, like I pointed to earlier, alluded to earlier, if you're got 20, 30 years that you're looking at retiring and you're saving up for that, then now's a good buying opportunity because things are at a discount, especially your staple names and your blue chips. There are going to be a lot of companies that go bankrupt and out of business, but typically your larger companies today are going to your blue chips today are going to most likely be around doing well far into the future, as it is a market that is geared more towards larger firms and larger companies to begin with. They're the ones who get all the government bailouts typically, or most typically and mostly. They're the ones who get the larger bailouts, and even though there is a small business push to give loans, as such as um, I read the article, I'll have to find who it was by, but it talked about Steak and Shake and how they're getting small business loans. Technically, they qualify under it, but I mean they're a fairly well capitalized company and definitely on the medium, maybe borderline to the larger cap, a small cap in the fact that they're a small cap compared to other $100 million firms, things of that nature, but not small, not small in that they're not your very micro $20 million, $50 million capitalized companies or your mom and pop's grocery store or business. So they're not the very small firms that you have that would that it really was intended for. But that's a different issue and a discussion for a different panel. But what we're also wanting to do is take a look at Snap, and we want to take a look as well. There is a stock I've been following for a little while since 30 cents, which is FECL, and I'll give you just a little teaser here of the FECL. Here's back when I actually was speculating on this back around 30 cents as a speculative buy. Then I saw this huge buy in here and a spike, and then I confirmed that this was definitely an uptrending stock, even though we took a dip again just because of the surge. All that activity, people are going to take profit somewhere, have held it here. And then, of course, it went back up there, still holding on. As we see, it goes up here, and we have a solid trend line up, another dip, another solid trend line up, and here we see it flattening out with less volatility, less volume, but possibly forming another good steady upward trend, but definitely a midterm steady upward trend. Not the same spike, but that's actually good because these spikes will give you short-term sell-offs if you're holding it steadily for a midterm investment. And if again, this is a benefactor. It was a benefactor before all the COVID, all the COVID crisis occurred and hit. It was is a benefactor before that, but now I think because they do fuel cells uh, and alternative energies, it's going to benefit when you have the oil companies and oil markets having less ability to capitalize and remain liquid. So therefore, a company like this could benefit just from the downtrend of other companies and people looking to push their money in alternatives outside of the oil sector. Uh, but we'll go more into depth on this and the metrics and some of the moving, some of the 20-day moving targets on this and why this is a good pick. As you see, the technical rating for the Yahoo Finance, we have bullish all we have green across the board here, short, mid, and long term all in FECL. So I like that one. I don't always agree with 100% with these technical analyses, but they're fairly good. They're fairly good indicators, and when my independent my independent research comes up with something, and then I look back at this and I say, okay, it's good that they're in agreement with what I'm saying. That's always a plus. But we can go more into depth on this again on our Global Guru Minute, which is a very short, well, not very well, it's a concise, let's say it's concise review of both macro trends, geopolitical events, and financial, of course, on the Global Guru Minute, which can be found on Spotify, uh, Anchor, as well as 4 or 5 other different platforms. I think we're up to 6 platforms right now on there, and most assuredly on the Patreon, where we can subscribe at the introductory and special rate of only right now of only $3 a month, which I will be upping the minimum in the future. But for now, I'm locking in people at the $3 a month, $3 a month only, just to give everyone an introductory as well as because of these difficult times. Everyone wants to spend a little bit less on everything to be careful and cautious. So that's definitely something we all want to do. You can still get the premium right now for only $5 a month, which these deals won't be around forever. So I would say take advantage of that and also help support me so I can continue to upgrade and bring you the type of information you need and want. Until then, we'll be continuing to broadcast and continuing to have a lot of this uh, entirely free content for you to help you improve your life at John Stanley Media. This is John Szymanski signing off for John Stanley Media.